history does not repeat, but it certainly does rhyme. All of the bubbles that I'm going to be talking about, it's not obvious that they were in bubbles until they're actually popped. Pop. Pop, pop, pop. And the reason market bubbles happen is because of a psychological process known as a positive feedback loop. So let's just say that you're an investor and you're wanting to invest in a hypothetical product. And so you look at how things have been performing in the past and you think, okay, this investment class has been performing pretty well. It's had a pretty good history. So I'll put more money into that. And then you, alongside of many other investors that have had the identical thought process as yourself, has then made that investment go up a little bit more. And so investors who stayed on the sideline before will then think, oh, okay, that investment has been going up for 2 years straight. So it's probably a good investment. So I'll put my money into it as well. And then they do that, and then the investment goes up even more and more. So this is what's known as a positive feedback cycle, where the positive news brings in more positive news, and it just keeps on going up and 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 up until one day a little bit of negative news comes in, or until someone doesn't get approved for a loan in order to buy more of these investments, and suddenly that breaks the positive feedback cycle. And so then you get to a point where it should level out in a perfect and rational world. However, this would cause some people to actually sell out, and then that causes a negative market feedback cycle. And you may notice with market bubbles and market crashes is that it seems to grow very slowly, but then it seems just to crash and lose everything overnight. And the reason for that is that greed is nowhere near as strong a motivator as fear. The fear is the reason why these bubbles pop so quickly. So now you know the basics of what a market crash is, and now I'll talk about some of the biggest crashes in history. So to start this off, I'll talk about Tulip Mania. So that's right, probably the most famous market crash in history, and so that happened in Holland between 1634 to 1637. And if you don't know about it, yes, I'm talking about tulips, as in, yes, those flowers. There was a bubble over flowers that many investors got caught up in. It's hard to believe that people could get caught in the flower bubble of all things. So these flowers were introduced from Turkey in 1593 into Holland and other parts of Europe. And they became so popular that a tulip value was equal to the price of an entire house. So just imagine that situation. I mean, you can have this house completely paid off and the house is totally yours, or you can have this one little flower. I mean, and people back then were picking the flower. And to be fair to them, I mean, this was kind of one of the first massive market crashes in modern history. So they were creating the history, so they couldn't actually really learn from history. Anyway, so with this mania, can you guess what happened next? That's right, it lost pretty much 100% of its value. I mean, technically speaking, it was 99.99999999999999999. But let's just round it off to 100% of its value. And so at the peak of the tulip's prices, it increased in price by 59-fold in 16 months, and then basically lost all of that within a month afterwards. This is in the United Kingdom, and this was in 1720, and it was a South Sea Company. This is a company that wanted to purchase the rights to shipping routes. And so what are rights to shipping routes? Basically, there's a governmental right that they sell on for permission to travel certain routes. And I know this seems like a ridiculous concept, but this still exists today. It's a big thing with the airlines that governments between two countries would only approve a certain amount of routes, and then airlines that want to fly that route have to get permissions and they have to buy those routes. So this is the case for Olden Days shipping as well. And what was the bubble actually in? It was in shares or stocks in the company that was actually specialized in owning a majority of these rights and then either renting out or leasing out these rights to shipping companies. So the bubble rose by 700%, and when it crashed, it fell by 90%. And the reason this is so bad wasn't so much because of the shipping routes themselves losing in value. I mean, shipping barely changed. It was more that suddenly the banks started saying, oh yeah, we're going to stop letting people borrow ridiculous amounts of money to invest in this. And so as the banks started clamping down on that, that suddenly stopped people from being able to invest in that, which broke that positive feedback cycle, which then started the negative feedback cycle. This is in the United Kingdom again, and this time it is about railways rather than the oceans. So in 1845, the government authorised for the construction of a lot more rail track. And this is good for people in the country as it enabled them to buy railway stocks, and also any company around the railway industry, whether they lay tracks or whether they sell tickets, and people were permitted to borrow money to buy these stocks with only 10% of their own money down and then 90% of the bank's money. And on a positive, in defense of these UK investors, I mean, at least railways are something tangible. I mean, they're not investing in something like flowers. Anyway, unfortunately, a lot of investors lost a lot of money, but this bubble was not actually a complete loss when it popped. Because the railway infrastructure had been built, and even though a lot of people lost a lot of money of it, this railway network ended up becoming very useful for the British government in the subsequent years. We're finally leaving Europe and we're moving over to the United States. So this is the famous 1929 black market, not black market, there's nothing illegal about it, the Black Thursday crash. So between 1929 to 1932, the market had lost 90% of its value. And this is the entire share market as well. This isn't just one asset class. It triggered not only a global recession, but a global depression that basically put a permanent mental scar in everyone that lived through it. So this is 1980, and it was precious metals. And when I say precious metals, although gold was affected, this is more about silver. So in 1979, silver went from $6 to $49. So Nelson Bunker Hunt and William Herbert Hunt and Lamar Hunt, also known as the Hunt brothers, attempted to corner the silver market in the same way that the De Beers had cornered the diamond market. And they purchased 1/3 of the entire world's silver supply that was not owned by a government. And in response to this, regulators and governments certainly were not very happy about this. So then they started putting in borrowing restrictions on being able to borrow money to buy silver. And guess what that did? It broke the positive feedback cycle. And unlike other bubbles, this one actually shot up almost as quickly as it shot down. And this affected the gold price as well. Gold tends to keep a bit of a correlation with the price of silver. This one is Japan in 1989. So at the time, Japan's economy was number 2 in the world, and the corporations are buying everything. I mean, I even remember as a kid even going to Brisbane and the Gold Coast. All the big theme parks and all the big buildings are owned by Japanese corporations. So this bubble was triggered when banks lowered their interest rates from 5% to 2.5% in 1987, which triggered a Japanese business investment mania. Now between 1985 to 1989, the Nikkei, which is basically a collection of the entire Japanese share market, tripled. And also on top of this as well is that there was a big real estate bubble going on in Japan at the same time as this because the lending was so generous and so easy back then. And so the combined land of Japan was worth 4 times more than the combined land all put together of the United States, even though the United States has 25 times more available land than Japan. And when this bubble popped, which basically is an entire country in both its share market and real estate market, it was a 50% devaluing. So yes, it wasn't a 90% crash like some of the previous bubbles before it, but that only affected a single company or a single asset class, whereas this is an entire country's economy and the second biggest in the world, crashing by 50%. And what's actually really sad about this though is that Japan has only just recovered from that 1989 crash in very recent years. They call this the lost 2 decades. Number 7, we're back to America, and this is the dot-com crash. So it was predicted in the 1990s that the world would become very dependent on computers and the internet, which ended up being correct. But just like in the other bubbles, money was coming in faster than what the technology was. So the bubble burst in 2000, and from when the bubble burst in 2000 to the low point of a NASDAQ, which is a collection of all the technology and internet and computer companies, there was a 78% drop from its peak to its low point. And it didn't affect the other companies in the share market near as much as what it affected technology companies. And as far as how long did it take to recover from this crash, well, the NASDAQ recovered to its previous highs from that 2000 crash in 2015. So it was a lost 1.5 decades. It started in America and then affected the entire world. This was the global financial crisis, and this bubble did start in real estate because there's that old saying that you can't lose money if you invest in real estate. Now unfortunately, there's so much money being borrowed. There's not so much that the real estate was a bad investment, but more just too much money was being borrowed that couldn't be serviced. Loans are being approved to people that just had zero hope of ever finding a way to be able to pay back that loan. Instead of calling it a real estate crash, I think it's more fair to call this a overly generous loans crash. And then one day, a few people noticed that these debts could not be serviced, and so that triggered a massive crash. And in response to any massive crash, the Federal Reserve said, okay, well, let's lower the interest rate from this to this. That would normally work, because if you actually are trying to make repayments on your debts and you're just struggling with actually making the amount, that would help. But the problem is, though, is that loans are being approved to people that weren't making any payments at all. Moving the goalpost to be a little bit closer and easier for you is still no good if you don't even kick the ball in the first place. And at the end of this crash, when all was said and done, the American market crashed by 48%. Should also mention as well that 48% does not seem that serious, but this pretty much happened to the entire world. And this one is very interesting because it may not be over. So Bitcoin went from $1 to $20,000 between 2010 to 2017. But when it crashed in 2017, it lost 82% of its value from its high. But what I found really interesting about this crash though, is that there's only the investors that got in late 2017 that actually lost money. The investors who got in before early 2017 still were making a profit after the crash, because most of Bitcoin's rise happened in late 2017. And so from the rise up to the big crash, it's actually one of the biggest market bubbles in history. But one thing that is historically unprecedented though, is that it just rose straight up again. So the question remains, are we in a second Bitcoin bubble? Or is this just a very turbulent ride in the rise of Bitcoin's future prices?
1 minute. 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 1 minute.
Bubbles are very hard to predict, and you never know that you're in a bubble until it pops. But one thing that is actually working on our side though is that historically speaking, the bubbles have many years between them. And in recent history, we have gotten a fair share with Japan, the GFC and the Dotcom crash and Bitcoin happening in such a short period of time. And so if you're using history as a bit of an indicator, normally there aren't so many bubbles and crashes in such a short period of time. So hopefully that is a trend that will reverse, but who knows if it will. I mean, history has always been written, and that includes today. I mean, right now for all we know, we could be in a second crypto bubble, we could be in a second tech bubble, or we could even be in an Australian property bubble. And unfortunately, we won't know until it actually happens. Anyway, but what do you guys think? Can you tell me in the comments what you think the next bubble will be that'll pop? As usual, I love discussion in the comments, and see you next week. Thanks.